The markets are shut. The monitors are dark. The ticker is stuck at 79.25. It is the holiday period. Most people are relaxing. Yet if you could see inside the boardrooms in Lower Manhattan right now, or the meeting rooms at the Federal Reserve, you would witness something very different. You would see fear. We are getting signals that urgent risk control sessions are taking place this weekend at the highest layers of the global financial structure. Why is this happening? Because silver jumped 10% in a single session, because a 10% surge in a key raw material is not only a trading story, it is a solvency story. When an asset such as silver moves that far, that fast, it breaks things. It wrecks the risk models used by major banks. It blows up margin arrangements at hedge funds, and most dangerously, it threatens the soundness of the clearinghouse. The clearinghouse is the backbone of the exchange system. It stands behind every deal. If a large bank cannot meet its obligations on Monday morning because it is short silver, then the clearinghouse must step in and pay. If the clearinghouse itself cannot pay, then the whole machine locks up. In this urgent transmission, we will reveal what is really taking place out of sight this weekend. We will study the emergency playbook that big institutions fall back on when they are trapped. We will examine the odds of rule changes at the start of the week, such as higher margin demands, position caps, and trading stops. And I will show you why these meetings do not signal strength, they signal a total loss of control. The banks are in these rooms because they are terrified of the Sunday night opening. They know that if silver opens with a gap to 85, the game may be finished. This is the tale of the weekend when the system blinked. To grasp why these talks are happening, you must understand the arithmetic of leverage. The big players do not trade silver only with their own money. They trade using borrowed funds. They frequently employ leverage of 20 to 1 and sometimes 50 to 1. That looks fantastic when markets are calm, and it seems to create free profits. When the market jumps 10% against them, that leverage becomes a weapon of mass destruction. Let us run the numbers. If a bank is geared 20 to 1 and price moves 5% in the wrong direction, it loses all of its own capital in that trade. Its equity is wiped out. Silver rose 10% on Saturday. That means any entity that was short and geared 10 to 1 or above is now technically broke. Their stake is gone. They owe money that they do not possess. In normal times, the bank simply issues a margin call and forces the client to post more cash or liquidate. Yet what happens if the client is too large to push into default? What if it's a huge industrial hedger, or a sovereign wealth fund, or another major bank? You cannot just dump their positions without blasting the entire market. So they convene a meeting, they call the supervisors, they contact the Federal Reserve. They say, we have a serious issue. If markets open on Monday, Bank X will default. We require a plan. This is exactly the pattern we saw in 2008 with Bear Stearns. It is what we witnessed in 1998 with long-term capital management. It is what took place in 1980 with the Hunt brothers. They gathered on a weekend in order to rewrite the rules so they would not have to settle the full bill. We believe that at this moment they are discussing containment tactics. They are trying to find a way to keep silver from opening at 85 tonight, because if it does, then insolvency spreads from the client to the banks themselves. We stand in front of a potential chain reaction, and silver is the spark. Now we will study the clearinghouse risk with more focus. The CME Group, which operates the COMEX, maintains a default fund. This is a capital pool provided by all member firms. It works like insurance. If one member fails, the pool absorbs the hit. Yet this fund is not limitless. With silver at 79, the face value of all short positions is measured in many billions. If price gaps higher again, the losses could outsize the default fund. That is the nightmare case. If the fund is drained, the exchange itself becomes vulnerable. Traders lose trust in the platform. They cease to trade. Liquidity disappears. To avoid this collapse, the exchange has emergency authorities. It can stop trading. It can take margins all the way to 100%. It can declare liquidation-only orders. This weekend, the attorneys are going through every clause. They are searching for the language that lets them shut off the buy button. They did this in nickel. They did this in GameStop. Do not assume they will spare silver. They will sacrifice almost anything to preserve the shell of the market, even if they ruin confidence in that market. Now we move to the collateral crunch. Banks use government securities as backing for their trades. At this point, the sovereign bond market is also shaking. A debt ceiling battle is close. Inflation is climbing, so the value of the pledged collateral is slipping at the same time that obligations tied to silver are rising. This forms a double squeeze. Banks feel pressure on their short positions. They also feel pressure on their collateral base. This forces them to sell other holdings to raise currency. On Monday, we may witness equities fall. We may see crypto prices fall, not because those assets are suddenly inferior, but because banks must unload anything they can in order to fund silver losses. This is how a squeeze in silver expands into a macro shock. It drains liquidity from the wider world to cover the hole in the precious metals complex. The gathering this weekend is not only about silver futures, it is about preventing a system-wide liquidity accident. They are seeking to isolate the blast. Yet here is their central problem. They can still manipulate the paper arena. They can rewrite rules on the COMEX. They cannot easily control the physical trade. They cannot command Shanghai. They cannot dictate premiums at local coin shops. If they shut the paper platform, or if they enforce an artificial ceiling, then physical trade can simply detach. Shanghai can trade at 100, while New York quotes stay near 79. Then every ounce still stored in Western vaults will head east in order to capture that gap. So the proposed cure deepens the disease. It drains inventories faster. They are cornered. Next, we must consider the psychological warfare that is likely ahead. When these emergency meetings occur, a narrative almost always leaks into major media. Expect headlines late Sunday. Things like regulators watching commodity price swings, big banks state liquidity is ample, analysts warn of silver mania. Their aim will be to talk the price lower. They want to frighten small investors into selling at the opening. They need your selling pressure so that they can purchase. They require your liquidity in order to patch their own blunders. Yet this time, the storyline may fail. The public no longer trusts banking voices. People look at screens. They see silver at 79. They see gold near 4,500. They see what is happening. The confidence game is falling apart. When trust dies, no set of meetings can revive it. Only new prices can do that. As we approach the Sunday Open, you must accept that the game is indeed rigged. Yet the old rigging is now misfiring. The leverage once used to sit on price is now the force driving it higher. The rules written to shield insiders now confine them. We are witnessing a slow-motion breakdown of the system. The outcome of that breakdown is real price discovery. The market is seeking the level at which banks stop hemorrhaging. That level sits far above 79. The urgent weekend session itself is the signal. It shows we have struck the pain threshold. Now we observe their reaction. Do they keep fighting or do they surrender? Let us dig further into the specific instruments they may roll out on Monday morning. What does a rule tweak really look like, and what might it do to your holdings? One classic maneuver during a squeeze is a steep margin hike. We saw a trial run recently when they lifted margins by 50%. That step failed. They can still go to the extreme. They can boost margins to 100%. That would mean no borrowing to buy silver. Every buyer must use full cash. That wipes out most speculators. If you're a hedge fund using leverage and you suddenly must post full value, you are forced to reduce or abandon your position. This creates forced selling. In 1980, this tool destroyed the Hunt brothers. Margins rose so far that the Hunts went broke.
Yet today, conditions are different. Current buyers are not only traders. Samsung is not operating on exchange margin. The People's Bank of China is not using exchange leverage. They are cash buyers. So a margin increase may wound the small trader, but it will not stop industrial giants. Those giants welcome margin hikes because they flush out weak holders and allow cheaper entry. The next measure is position limits. The exchange can announce that no participant may hold more than a set quantity, such as 3,000 contracts. If somebody holds 5,000, they must cut 2,000 contracts by a specific deadline. This is direct interference. It forces large players to shrink participation. Yet the market has evolved. If the COMEX imposes such limits, the whales simply shift to the over-the-counter realm. They migrate to London. They move to Shanghai. Capital is fluid. It finds paths around obstacles. You cannot block a planet-wide scramble for metal just by erecting a modest barrier in New York. So the proposed cure deepens the disease. It drains inventories faster. They are cornered. The last and most extreme option is liquidation only. The exchange rules that traders may sell contracts but may not open new long positions. The buy button goes dark. That structure assures falling prices because no new official demand is admitted. If they take this path, it marks the death of the COMEX as a credible venue. It shatters trust in United States futures markets. Global investors will flee. They will search out venues that allow genuine two-way trade. Shanghai will still welcome orders. Dubai will still welcome orders. If New York bars buyers, it effectively hands global price discovery to China. The geopolitical cost of liquidation only is immense. They might threaten it. Actually using it is close to suicide for the dollar system.
So the banks find themselves trapped. They still have tools. Each tool extracts a brutal price. Every interference speeds the flight away from dollar assets. Every rule tweak is yet more proof that the structure is broken. They are trying to extinguish a blaze using explosives. This weekend's summit is an attempt to choreograph a soft landing. They hope to allow price to rise in stages. They want to manage the climb so that it does not bankrupt them in a single move. Markets in a vertical phase are not manageable. Crowd psychology has taken over. The crowd senses weakness. We must also examine the Monday opening gap. Because of these secret meetings and the surrounding doubt, liquidity on Sunday night will likely be thin. No trader is eager to take a large stance before learning the updated rule set. That means the order book may be almost empty. If a determined buyer arrives, price can jump instantly. We may see silver open near 85 purely because banks are reluctant to sell. Fear can operate in both directions. Banks fear new short exposure. Traders fear being short. The natural direction is upward because nobody wants to step in front of a runaway train. This fear gap is a vital signal. If we open far higher, it implies the talks failed. It shows they did not manage a solution. It implies that panic is now uncontrolled. If instead we open with a gap lower and silver prints 75, it suggests they found a way to hit the market. That might be a joint central bank sale. It might be a sudden rule shift. If this latter case unfolds, you should not panic. That drop is an opening. It is the system handing you one last chance to secure real metal at a depressed paper quote before physical conditions overpower the futures market's tricks. You must learn to interpret the language of gaps. A gap upward signals failure of control. A gap downward signals a brief intervention. Both paths finally lead to much higher levels, though at different speeds. We must also study the part played by retail bullion dealers. They are watching these meetings as closely as traders. They know that any change in rules could render their hedges useless, so they maintain wide premiums. They are defending inventory. Do not expect the dealer freeze to vanish on Monday.
If wild swings continue, more dealers may pause operations. The gap between spot and physical prices will stretch wider. Spot could read 80, while actual coins trade near 110. That margin represents the risk premium of a damaged system. As an owner, you must focus on the physical quote. That is your true wealth. The futures quote is only a digital reference point used to net out wagers between banks. Physical price is what you can obtain for your metal in direct trade, and real-world bids are marching higher. So the office lights are on, coffee pots are refilled, lawyers raise their voices, the weekend negotiation drags onward. They hunt for an escape route. There is no escape. They promised more silver than the world holds. The rightful owners now demand delivery. This is the oldest pattern in markets, a short squeeze in a finite resource. You cannot print silver. You cannot vote new silver into being. You must mine it or buy it. In this moment, they can do neither fast enough. Monday approaches. Judgment approaches. Hold the line. We now turn to the question of contagion. This weekend summit is not centered solely on silver contracts. It touches the plumbing of global finance. Silver does not live apart from other markets. It links directly into the repo system. The repo market is Wall Street's pawn shop. Banks lend each other funds overnight with collateral such as treasury bills. Yet when violent swings strike a core asset, such as a 10% jump in silver, they shock the risk models that guide repo lending. If a bank is burning cash to meet a margin demand in silver, it cuts back on lending in repo. It hoards cash. This hoarding drives overnight funding rates sharply higher. It triggers a freeze in liquidity. We saw the pattern in September 2019 when the repo system seized. The Federal Reserve had to create huge amounts of cash in an instant. We now see hints that this spike in silver is causing a similar seizure in the hidden plumbing. Banks eye each other with doubt. Are you the one short silver? Are you the one on the brink? When faith disappears, credit disappears. When credit disappears, equities collapse. This is why the Federal Reserve sits in those weekend rooms. It has little direct concern for the quote of silver itself. It cares about the balance sheet of a giant such as J.P. Morgan. If J.P. Morgan cannot secure liquidity because its books are impaired, the Fed must intervene. This is the fabled Fed put. Here lies the cruel irony. If the Fed rescues banks, it must create new money. Creation of new money drives silver even higher. The authorities are stuck in a circular trap. To restrain silver, they must do the very thing that intensifies the rise in silver. Now we move to the revenge of the miners. While bankers sweat in New York, the executives at mining houses are opening bottles in celebration. For a full decade, miners have suffered under the weight of suppressed paper prices. They dug the ore while bankers set the reference price. Miners survived on razor-thin profit margins while banks earned fortunes flipping paper claims. Today, the power has shifted. Miners possess what banks now desperately need, namely actual metal, and miners are not in a hurry to let it go. We hear early accounts of strategic withholding. Some producers are keeping new output at mine sites instead of delivering to refiners at current quotes. Why take this path? Because they understand that the squeeze is underway. Why accept 79 now when 100 seems likely next week? They now act more like central banks. They are actively managing reserves. This behavior creates a gap in supply. Banks expected mine supply to flow steadily into the COMEX to ease pressure. That flow is slowing. Silver stays in vaults in Mexico or Peru. This forces banks to raise bids further. They must tempt miners with much better offers to release stock, and miners demand rich premiums. We also must revisit the risk of nationalization. It is still Sunday. Governments in Latin America watch these moves. Mexico alone produces roughly 1/4 of global silver. If silver races towards 100, do you really think Mexico's leaders will allow foreign firms to keep every dollar of that upside? They will impose excess profit levies, or they will require that a portion of production remain in country for strategic stockpiles. If Mexico announces any export limit on Monday morning, silver could double on the spot. Banks are well aware of this possibility. That is a central piece of their anxiety. They sit on short exposure in a strategic metal that comes largely from foreign soil. That risk cannot be hedged away. Now we consider the rumors surrounding failures in the shadow banking world. In every crisis, there is a surprise victim. In 2008, it was Lehman Brothers. In this round, it is likely to be some unregulated lending pool or a vast commodity trading advisor. These players use immense leverage without the same safety nets that surround large banks. Whispers suggest that a major commodity fund in London is already ruined. It was short silver and long government bonds. Both sides moved against it. If that fund enters liquidation on Monday, its positions will be closed by brute force. That means a huge market order to buy silver. Forced buying does not care about chart resistance. It does not care about overbought levels. It simply executes until positions are flat. This is the fuel for a vertical advance. We are not only seeing natural demand, we are witnessing the machinery of forced liquidation. Such an event creates an air pocket in price. The market is pulled higher faster than any news headline alone could achieve. Because all this occurs during holiday trading, the air pocket is even stronger. Next, consider participation from the technology sector. We spoke earlier about companies like Samsung and Microsoft. Do you believe their procurement teams are resting this weekend? They are not. They are working on clock. They seek private deals outside normal channels. They call mining firms directly and offer to secure entire production years in advance, such as buying all of the output for 2026 at negotiated prices. Once a miner signs such an agreement, that metal never reaches open trading. It simply vanishes from the visible float. This shrinks supply for the public. Stock levels on the COMEX fall because an invisible stockpile is rising on corporate balance sheets. This trend is the privatization of supply. The market splits in two. One side is the public price, which is erratic and unstable. The other is the private price, which is much higher. Banks are now confined to the public arena as they scramble to cover short positions in a pool that is being drained from beneath them by secret corporate deals. Now we examine your gap strategy for Monday. If you are holding plenty of cash, you may feel uneasy. You want exposure, yet fear buying at a peak. You hope for a pullback. In a genuine liquidity crunch, pullbacks tend to be shallow and fast. If silver opens near 85, do not chase it in the first few seconds. Wait through the early hour if possible. After large gaps upward, there is often a wave of profit-taking in the first hour, as early longs lock in gains. Price dips back to retest the breakout level. That zone can offer an entry. However, in a runaway move, the usual dip does not always appear. Price can go limit up and stay locked there. If that occurs, the opportunity for new entry has passed. That is why securing at least a starter core position ahead of time is so important. You need a foundation that you never trade. That core protects you in case of the melt-up. Now we revisit the link with gold. Gold is trading near 4,534. It is firm and steady. It acts as an anchor. As long as gold maintains those heights, silver cannot suffer a deep crash. If silver dropped abruptly to 50, the gold-to-silver ratio would explode toward 90. Arbitrage systems would instantly sell gold and buy silver to narrow that spread. So gold creates a mathematical floor under silver. Banks cannot hammer silver without hammering gold at the same time. It is harder to strike gold down because official central banks are heavy buyers. You cannot easily intimidate a central bank. Thus, banks are fighting on two fronts and losing ground in both theaters. Let us address the silence in mainstream outlets again. Why is this not splashed across the front page of the Wall Street Journal? Because open coverage might create panic. If the public understands that banks may be insolvent and that the currency unit is faltering, we could see lines at bank branches. We could see runs on grocery stores. We could see a rush into anything tangible that smells like hyperinflation behavior. So major media outlets focus on technology earnings or political drama. They seek to distract the herd. The herd is beginning to awaken. Search patterns on major platforms do not lie. Queries for silver price are soaring. People are bypassing media editors and going straight to live quotes. This base-level awakening is powerful. It implies that the next surge of buying will be in physical form, not paper trackers, real coins and bars. Those are exactly the things banks cannot manufacture. They can conjure a future contract at zero marginal cost. They cannot conjure a silver eagle. So, as we wait for the Sunday open, tension is at its peak. Meetings continue. They seek some form of rescue and fresh rules. Time is scarce. Dawn is coming in Asia. Their markets will open first. The verdict is near. In the next part, we analyze the technical targets. Once we breach 80, where are the next waypoints? Do we stop near 90 or at 100? We will examine Fibonacci extension levels and the territory beyond the old highs. We will also deal with the psychology of holding through wild swings. How can you remain steady when your net worth swings 20% per session? Stay with us. The chart is about to write a new chapter. Now we lay out the technical roadmap. When an asset breaks above its former peak, it enters what chart watchers call blue sky. This means there is no prior trading history to guide us. There are no old highs as targets. So, what do algos use as reference? They lean on Fibonacci extensions. These are numeric ratios found throughout nature. They often describe human crowd behavior when other guideposts are absent. We sit near 79.25. If we measure from the breakout level at 50, the first major Fibonacci extension is the 1.272 level. That gives a target close to 85. This is the first magnet. When markets reopen Sunday night, many strategies will be tuned to chase toward 85. It acts like a tractor beam. If price breaks through 85, the next focus is the golden ratio, the 1.618 extension. That points near 96. Just above that is the obvious psychological barrier at 100. So the near-term path is fairly clear. First 85, then 96, then 100. These are not random guesses. They are numeric waypoints used by fast trading systems to orient themselves in new territory. Those systems will buy until they approach each landmark. Then they will pause and reload. There is also a human layer to blue sky moves: euphoria. When a chart prints a record high every day, it creates a loop of attention. Media cannot pretend it doesn't exist. The public cannot avoid hearing about it. The pattern becomes viral. People share the picture. They ask one another whether they saw silver lately. This social energy propels price through the Fibonacci bands. It supplies new capital to sustain the vertical climb. We are watching a shift from a pure technical breakout into a social breakout. Social breakouts are disorderly, violent, and can be enormously profitable. Now we look at the retail stampede. We touched on this point before, yet its scale deserves focus. Ordinary savers hold trillions in bank accounts that earn less than inflation. They hold trillions more in simple checking balances. Historically, the broad public joins a bull trend last. When they do arrive, they bring a flood of money that overwhelms professional flows. Today, the public is waking up. They face an access barrier. In 1980, a person could walk into a local shop and buy a bag of junk silver. Today, in 2025, many local shops are bare. Online dealers often show out of stock or their sites choke under heavy demand. Many exchange-traded funds trade at premiums and face trust issues. So, where does average money go? It pours into mining equities. That's the easiest route for the typical investor. They pull up a trading app, type silver, and tap buy on the first miner in the list. Because of this, we expect the mining sector to go vertical next week. It's the only place where the retail crowd can fit size. If you already own miners, prepare yourself. You may soon face a wave of inflows from millions of small buyers who want silver exposure yet cannot acquire bullion. Tiny penny names can quickly become dollar names. Stocks currently at $1 can become 10. This is the echo effect of the squeeze on the underlying metal. Shortage of the physical forces surplus cash into related stocks. We must also discuss the psychological hurdle at 100. 3 digits feel unreal to anyone who remembers silver at 5. In a currency crisis or a hyperinflation setting, zeros accumulate quickly. Remember Bitcoin? It went from 100 to 1,000 in a brief window. When a mental framework changes, the unit scale changes.
At 100, the human brain flips. Investors stop thinking in ounces and start thinking in grams. Dealers rebrand to grams to soften sticker shock. Buy a gram of silver for $3 sounds gentler than buy an ounce for 100. This marketing shift brings in the smallest savers, for instance, people with $50. It spreads participation across millions. That dispersed base cannot be forced out by margin calls because most of them paid in full. Now we review the industrial substitution story. Banks hope that high prices will scare industry away at levels such as 80. They rely on the idea that users will reduce demand. We know this belief is flawed. For a missile system, the silver cost is trivial. For a solar panel, silver is a small fraction of total cost. There is even an opposite effect, panic stockpiling. If a corporate leader expects silver at 100 soon, he does not say stop buying. He often orders procurement to buy extra. He might lock in 2 full years of supply at today's price and feel brilliant if price reaches 150 later. So in the short run, higher prices lift industrial demand and trigger hoarding inside boardrooms. That removes yet more metal from circulation and accelerates shortage. Banks are still using a tidy textbook model of economics, while the real world follows behavioral economics. They're reading the wrong manual. Now we return to the emergency summit. What is the absolute last resort for officials? If they cannot control price, and if the clearinghouse looks ready to fail, they may try to strip silver of some financial status. They could rule that silver is unacceptable as collateral in key systems. They could slam gains on silver with punitive tax rates, such as 80%. They might even move toward restricting private ownership of bullion. These are end-stage risks. We are not at that point now, but you must know they exist. When a government loses its grip on its currency, it often attacks rival stores of value. Silver is one such rival. That is why privacy matters. If they reach for bans or crushing taxes, you want your holdings low profile. You want ounces already outside the most visible channels. The extra markup we discussed earlier represents the premium for that privacy. If officials clamp down on silver, that can in fact prove bullish for the physical owner. The open market value adjusts higher, even though the situation feels intimidating. Next, we examine currency swap lines.
The Federal Reserve maintains swap arrangements with other central banks. Through these, it can send dollars abroad to keep overseas banking systems liquid. This weekend, some of those lines are likely running hot. The Fed is dispatching dollars to Europe and Asia so that their institutions can plug losses in commodities. This flow means ever more dollars in circulation. Reflation of the system lifts hard assets, so the very tool used to preserve big banks assures that silver finds higher ground. Once again, the guardians of the system trap themselves. They choose to weaken the unit of account in order to save the existing structure. That trade-off is the essence of a crack-up boom. Asset prices rocket because faith in currency erodes. For Sunday night, we focus on the opening of Asian platforms. We already spoke of gaps. Now we must watch trading volume. Asian sessions are usually thin early. This time, we expect intense flow from the opening bell. Arbitrage desks will be in position. They will watch Shanghai quotes versus New York electronic quotes. If we witness heavy volume right away, that validates the move. A surge on weak volume can be faded. A surge on huge volume is more solid. If millions of ounces change hands in the first hour, it signals that banks are capitulating. If trade is quiet, they may be holding back for a surprise intervention later in the day. We also track crude oil. Oil is the master commodity. If oil spikes Monday due to world tensions, it will pull silver higher with it. Higher oil costs raise mining expenses and feed inflation expectations. Silver and oil often travel together in panics. If oil breaks above 80 or 90, then silver will likely punch through 80 fast. We also monitor yields on Treasury notes. If the 10-year yield jumps, it reflects a falling bond market. Normally, higher yields hurt silver. In a true debt scare, they can support silver because they show that government control is slipping. If yields and silver both rise sharply, we are observing a sovereign debt crisis. It means markets reject government IOUs. We saw similar patterns in the 1970s, and we see hints once again. So our Sunday checklist is as follows. Watch the opening quote. Does silver trade above 80? Watch turnover. Is volume strong or weak? Watch gold. Does it hold near 4,500? Watch oil. Is it trending higher? Watch yields. Are they climbing? If all these signals flash green, then there is no effective ceiling in the short term. We move to 85, then 90, and beyond. The emergency summit will have failed, and actual supply and demand will have seized control. In the last part, we pulled together this investigation. We set out a practical Monday program. What actions should you take as trading resumes? Should you add exposure? Should you trim? Should you hedge? I will present a step-by-step outline to shield your wealth in a limit-up environment. Then I will leave you with one closing thought on why this particular weekend marks a major turning point. Life before this weekend and life after will unfold in different financial worlds. The era of pure paper promises is fading. The era of real assets is dawning. Stay with us. The conclusion is next.
We have reached the decision point. We have spent this session dissecting the weekend summits, the risks at the clearinghouses, and the industrial scramble now surrounding silver. We studied the charts, the politics, and the arithmetic. Now we turn to your own holdings. In less than a day, trading resumes. Algorithms power back on. Funds begin to move. You will face perhaps the most chaotic market open of your life. Your choices in the first hour, or your choice to remain inactive, could shape your finances for many years. In this closing chapter, Part 4, I will outline your Monday opening plan. I will explain how to act in a market that keeps locking limit up. I will offer backup plans for the worst case of an exchange halt. Finally, I will offer mental armor so that you can sit tight while others around you panic. Their meeting is over. The bankers have made their move. Now you must choose your own. Rule 1 for Monday is direct. Do not sell.
This sounds simple for those who always intended to hold physical silver for the long term. Yet when you see price jump on the open and your account leap 10 or 20% in seconds, you will feel a strong urge to lock in gains. You may tell yourself that you will sell now and buy back lower. That is the trap. In a true liquidation scramble, there may be no deep low. If major shorts must cover, they will buy every contract they can find. If you dump your position at 82, you might never regain it. You may watch price run to 85, then 90, then 100, while you sit in cash, begging for a crash that never arrives. You would be surrendering a scarce asset in exchange for an easily printed asset. In a confidence storm, you want to hold what is scarce. Unless you absolutely need cash for urgent bills, do not sell into the blast. Allow the market to move. Allow the shorts to feel the pain. Allow true price discovery. Your reward flows from patience. Step 2 is about your exposure to counterparties. If you hold physical silver directly under your own control, you can largely ignore this step because you are far safer. If your silver sits inside a vaulting service, an exchange-traded fund, or a standard brokerage account, then you must examine counterparty risk right away. Read the client agreement. Search for the force majeure language. Search for any right to settle your position in cash only. If the exchange stops or restricts trading, does your provider have the power to close your holdings at the last official rate? If so, you face real risk. Over this weekend, you should weigh shifting assets out of large banks and into private non-bank storage. If you own a fund share, you might consider selling that vehicle and moving into real metal or into miners. Mining shares do carry equity risk. They do not carry the same delivery risk as pure paper silver. You hold a stake in a firm that owns a real deposit. A deposit in the ground cannot declare force majeure. The ounces exist. We are moving into a period where possession counts for most of the law. If you cannot touch it, you may not own it once the storm hits. We must also address the nuclear situation. What if losses run so deep that COMEX does not open at all on Monday? Or what if trading opens, spikes limit up, and then is frozen for an undefined span in the name of orderly markets? This has precedenters. It happened in nickel. It happened around the Hunt saga. It is not fantasy. If the exchange closes, price on screens will freeze. It may stay stuck near $79.25 for days. Meanwhile, real street prices will float away. In that frozen world, a gray market emerges. Dealers will quote based on Shanghai or on live supply and demand. You may see a quoted spot near 79 while eagles change hands for 120. If that unfolds, do not be shaken. A closed exchange is final proof that your thesis was valid. It means the old paper control structure has failed. It signals that once trading resumes, silver will likely reset much higher. Do not let go of physical stock for a frozen quote that does not reflect reality. Ignore the electronic number. Wait while dust settles. The true value of your metal is set by scarcity and use, not by a stuck computer in New York. Next, we see the openings for new capital. If you missed the first run in metal or want to increase exposure, where should you focus? Your best route may be the miners. We have spoken in general about miners. Now we narrow focus for this Monday. If silver gaps higher, mining shares will open with big gains, and they will show more volatility. If silver is up 10%, miners could be up 20 or more. There is one special group worth attention: developers. These are exploration and development firms that have located silver but have not yet built full mines. In bear cycles, these exist near death, as nobody wants to fund construction. In a tight bull market, these become buyout targets. Large producing companies face dwindling reserves, yet receive huge cash flow at new prices. They must secure future supply. They will look to purchase smaller developers with rich deposits in stable regions. During such takeovers, share prices often jump 40 to 50% overnight. That is the lottery ticket stage of a metal bull run. If your risk tolerance is high, you can research high-grade developers in sound jurisdictions as they form the next likely acquisition list. I also want to equip you with a mental trick for riding out the storm. Stop marking your silver in dollars each day. The dollar itself now slides while silver climbs. Any chart that compares them shows relative motion of two shifting points. Instead, value your holdings in real goods. Ask how many ounces of silver it would take to buy a typical house. In 1980, it took roughly 800 ounces. Today, at $79 per ounce, it takes around 5,000. We are far from 1980-style buying power. Ask how many ounces buy the Dow Index. We spoke of this ratio earlier. It must fall sharply before the cycle is complete. When you anchor your thinking in real terms, you no longer obsess over each tick. 79 becomes just another marker along the road. The real destination is freedom from financial fragility. That will require levels much higher than you see today. Prepare yourself for an ugly narrative shift as prices climb. Politicians will step in. They will label silver owners as hoarders or speculators or even threats to social goals. They will claim that you are blocking the green transition. They will attempt to shame or bully you into selling. Understand this for what it is: propaganda. You are not a saboteur. You are a saver who saw inflation early. You saw resource scarcity early. You are being rewarded for foresight. Do not let hostile commentary drive you out of a sound position. The authorities created the predicament with excessive money creation and with policies that crippled mining. Market forces now repair the imbalance by lifting price. Your only crime is having noticed before they did. Stand firm. Here is a simple checklist for the Monday Open. First, view the Shanghai quote. Is it leading higher? Second, watch the Globex Open. Do we gap up? Third, scan headlines. Are there confirmed failures among banks or funds? Fourth, call or check dealers. Are they still willing to sell? If all answers are yes, then we face a near vertical acceleration. In that situation, the best tactic is often to sit still. Place your hands away from your keyboard. Allow the fireworks. Do not trade frantically for a few dollars here and there. You might lose your core stake on the rocket. If, instead, we see a gap down, the rug pull pattern, check the turnover. If volume is low, the move is likely a trap. That is a buyable dip. If volume is huge and there is fresh news of central bank action, then we pause and reassess. For now, a deep crash appears less likely than a continued rise. The odds favor a melt-up. We are present at a historic moment. In future years, analysts will study the silver squeeze of 2025. They will publish research on this weekend when major institutions lost control. They will print the very charts now on your screen. You are not just watching, you are engaged. You belong to the group that saw the pressure build in the dam before it burst. Very few people ever stand on the correct side of a massive wealth shift. You have that chance now. Do not throw it away through impatience or anxiety. The underlying math cannot be wished away. The debts cannot be repaid in honest terms. The available silver cannot cover all claims. Price has to move upward, and that move is already rapid. So here is the final verdict. The emergency summit highlighted weakness, not power. The banks met because they have lost control. The physical trade has seized the wheel from the paper trade. Monday will be hectic and loud and frightening. For those who already hold silver, it will likely be rewarding. 79.25 has become the base level for this new phase. 80 is the threshold. 100 is the next milestone. Rest up. Review your security. Prepare for the opening bell. The greatest financial drama of this era is about to begin.